What is implied volatility in options on futures? Have you ever wondered how traders gauge the uncertainty of future price movements in the market? One key concept that comes into play is implied volatility. Implied volatility, often abbreviated as Roman 4, is a measure of the market's expectation of how much the price of an underlying futures contract will fluctuate over a specific period. Unlike historical volatility, which looks at past price changes, implied volatility is forward-looking and based on current market prices of options. In the realm of options on futures, implied volatility plays a vital role in pricing models. One common model used is the Black-Scholes model, which has been adapted for futures options. The level of implied volatility directly influences the premium of the option. When implied volatility is high, option premiums tend to be higher as traders anticipate larger price swings. Conversely, when implied volatility is low, option premiums decrease, indicating expectations of smaller price movements. Traders keep a close eye on implied volatility to gauge market sentiment and risk. For instance, when implied volatility rises, it often signals increased uncertainty or bearish market sentiment. This can prompt traders to adjust their strategies to manage risk effectively. On the other hand, a decrease in implied volatility typically reflects a more stable or bullish outlook. There are practical applications for traders when it comes to implied volatility. One strategy is volatility trading, where traders may buy options when implied volatility is low, anticipating a rise in volatility and, consequently, an increase in option premiums. Another common strategy is hedging. Futures traders utilize options with insights from implied volatility to protect against adverse price moves in the underlying futures. Additionally, traders might implement spread strategies that benefit from changes in implied volatility. Examples include calendar spreads or volatility spreads, which can be effective in various market conditions. It is important to note that futures markets can be influenced by numerous factors, such as supply and demand dynamics, geopolitical events, and economic data. These factors can impact price fluctuations, making implied volatility a useful tool for traders to anticipate potential market movements. In essence, implied volatility in options on futures quantifies the market's forecast of future price variability of the underlying futures contract. Understanding this concept is essential for effective option pricing, risk management, and strategy development in futures trading.